Welcome to So in the Know, a podcast that is dedicated to shared ownership. I'm your host, Sarah Ellis, and today we're going to be looking at mortgages for beginners. So whether you're a first-time buyer or you're looking to do your first ever remortgage, we're going to be exploring mortgages like we've never explored them before. Now, to help me in my conversations today, I'm joined by Cassidy and Aston from Barclays, who are going to be sharing their expertise on how to apply for a mortgage, what to consider, and where to start. So thank you so much for joining me today. Now, before we get stuck into the topic, it would be really good to just understand a little bit more about you and what it is that you do at Barclays.
Sure. Well, thank you very much for having us. We're very pleased to be here. I'm Cassidy. I'm a director at Barclays. I look after my team, I should say, look after our partnerships with our mortgage brokers and the firms that the mortgage brokers are part of.
Sarah, it's great to be here today. So thanks for the kind invite. So Matt Aston, I'm head of new builds. I'm really fortunate to do a role that I absolutely love. I look after our proposition in the new build sector. So that's across affordable housing and deal with shared ownership as well across housing developers and housing associations.
Fabulous. Well, thank you so much for taking the time out to come and speak to us today. Now, I really want to take this right back to the bare basics. And I think probably the natural place to start is interest rates. I mean, what is an interest rate and how does that impact a mortgage?
Yeah, do you know, it's so interesting when you ask that question because it really makes you think and, like you say, go back to basics. The not so exciting thing about buying a property and having a mortgage is having to pay it back. But unfortunately, we have to do that. And on top of that, you actually have to pay back interest on top of the loan that you're taking. So it will really depend on who you're lending from. So there's over 100 lenders in the UK. So Barclays obviously being one of them. We're a high street lender. There's lots of different lenders that you could choose from and get a mortgage from. And what we base that interest rate on really is the risk that we see as a lender from the person, the property, and the scenario of the person taking out a loan. So I guess you could look at the deposit that you have. So if you have a large deposit, you're not going to be as a risk to us, but that's okay. If you were buying a certain type of property, if it was residential or buy to let, that might have an impact on what the interest rate is as well. So there's lots of different scenarios and things for us to consider when we're lending money to a customer, and that will have an effect on what the interest rate is and how much you have to pay back.
And there are different types of mortgage in that some are fixed and some are variable. Yes. But yeah, what does that mean?
Yeah, so a fixed rate mortgage. So you could choose a typical term might be 2 years or 5 years, where at the beginning the lender will say, you will pay 4% for 2 years for your loan, or it might be a 5-year term. That's probably going to be a higher interest rate. Or you might have a tracker interest rate. So that means it could track the Bank of England base rate as an example. That could be plus or minus, but that will be variable as you go throughout your term of your mortgage as well.
Okay, and I was just about to ask about the Bank of England base rate because it's always in the press, isn't it?
It's very topical.
You know, it's headline, Bank of England base rate has changed again. But what does that really mean for mortgages?
Okay, so Bank of England base rate, where are we right now? So we're at 4.5%. That was reduced last month by the Bank of England, so 4.5. If we look back, so it's always really interesting when you think about the base rate to look at the past before you start looking at the future and think what you might be paying. So if you look back 12 months, and you may have seen in the media, we're talking about high interest rates, a high interest rate environment, your interest payments going up dramatically. If you look back 12 months ago, the base rate was 0.75% higher at that point. So you may have been seeing interest rates at maybe around 6%. If you look back 5 years before before that. So we're in 2025 now, so to 2020.
Great time for mortgages.
It was a brilliant time for mortgages. And we were probably in this, an area of never thinking that would change. But the Bank of England base rate was 0.1% at that time.
Wow.
So we're in a very low interest rate environment. So if in 2020 you took a 5-year fixed rate, you come to 2025 and your fixed rate's now up, you know, your payments are going to be significantly higher than they were before. Lenders do a lot of work in the background to mitigate that risk, to make sure that we're really sure that you can, as a customer, pay that back if interest rates do go up. I mean, I don't think anyone would have thought they would have gone up that quickly within that period of time. No. However, they did. But in terms of paying it back, you know, customers are able to do that because we made sure they could when they took out the loan in the first place.
Yeah, exactly. And another piece that you always see in the news is about, you know, rates going up, rates going down. But people that are out looking for a mortgage now, you know, what do you envisage in the next 12 months could potentially happen?
Gosh, if I had a magic ball and asked that, we were discussing this earlier, and if we knew that, we definitely know what type of mortgage that we take for ourselves going forward. But I guess you can base it on a few things. You've got the Bank of England base rate, so you know where that is. The market's predicting that the base rate will probably go down twice more in this year. So that's a good indication that interest rates should come down going forward as well. If you look at fixed rate, the Bank of England base rate doesn't actually affect a fixed rate and how much we charge for that. It's very complicated, so I won't go into the full detail, but what we do is we look at something called a swap rate, and we kind of use that as a bet to what we think interest rates are going to do going forward. Now, sometimes they don't exactly correlate with the base rate, but I guess that's a fairly good indicator. But we'll use that measure to price in for the future. So if you look at the moment how the tracker mortgages and the fixed rates are priced, trackers are higher. So that could indicate that we think the base rate is going to go down in the future.
Okay, interesting. And if you have a mortgage, but then all of a sudden rates go down, is there anything that you can do? Can you swap onto a lower rate?
And things can change during that mortgage term. So to your point, if interest rates start to come down, is there the ability to actually switch rate if the rate that you're paying is slightly higher than what the market is offering? There may be. There may be the position where that customer is actually tied into their rate. So they might have taken a 2-year fixed rate or a 5-year fixed rate, and so they're tied in for that term. There may be a product where they haven't got a tie, so they've got an option to switch. So it's making sure that when that mortgage is initially taken out, the customer is absolutely clear on the terms and conditions of that product, so they're really comfortable with what it is and what options are available. The beauty of the market at the minute is that, and talking generally around lenders, is that there's so much more choices for customers in how they switch their rates. Typically when a customer comes to the end of their mortgage term, there will be the ability to move anyway, but it's just recognising what does their current product do for them at this point in time. Are they tied in, and when could they move if that was something that they wanted to do?
And let's say someone did come out of their mortgage before that fixed term was up. What are the financial consequences of doing that?
Okay, so that would then be the activation of the early repayment charge potentially. So the first thing to do would be to assess, you know, what rate is available, what rate were we looking to move to, what is the cost saving, and then to obviously liaise with the particular lender to see what the penalty would be if there is one, and what that charge would be, because you know, the financial implications of moving rate may actually water down the impact of actually doing it. So it may be best to understand what the options are from a timing point of view of moving that product.
I actually did that once. So I was selling a home, buying another, and the seller was putting a lot of pressure on me to move quickly. But I had a couple of months between my fixed rate being up and when this customer actually this seller, actually wanted us to complete. So I decided to break my fixed term early, and there was about a £6,000 penalty for doing that. But I'd saved about 15 grand on the price of the house because I'd negotiated effectively. So as you say, you sort of need to weigh up, the reason in breaking it. No, that's really helpful. Thank you. So I think we've got a better understanding of interest rates, which is great. I want to take it back again a bit further. So let's now look at the application process. So what's the first thing that you should do if you're looking for a mortgage?
Okay. Well, I think the first thing that a consumer does is to think, well, actually, where do I want to live? So location still drives, probably at the top of the list. And then from an affordability point of view, it's quite important that, I've found a location of where I'd like to live, area, is it linked to, potential schools? So there's a reason why was it, close to family. So once that has actually been done, it's really drilling down on what can I as the customer afford. What type of property do I need? How many bedrooms? And that's at the point where it's looking at that research and certainly seeking that independent advice. And it's important when seeking advice that, it is true whole of market advice to see what options are available to me, because depending on my circumstances, there will be lenders that may offer me different amounts from a mortgage point of view. From that point of view, it will be then potentially getting an agreement in principle with a recommended lender. And then from an application point of view, once I've had an offer accepted for that particular home, then to proceed with the application. And then it would be following its normal path of valuation of the property to then move to an offer and that glorious moment when move in and complete.
It all sounds so simple, but there are a few factors to consider in that application process. And one being, credit score. You hear about credit score all the time, but what is a credit score and how does it impact your ability to get a mortgage?
Okay, so credit score. So a lot of people would have heard of a credit search, but also a credit score. So a credit search would be where a customer can obtain their credit report. So there's various credit bureaus that are out there that give customers access to their financial situation, and that will detail from their bank accounts to any credit commitments that they have and how they are performing, and is that individual keeping up with their repayments, how long they've been repaying for. So it's a good financial health check. A credit score is used by a number of lenders. It's not necessarily used by all lenders, but it is used by a high proportion, and that's based on a mixture of criteria for that individual. So and it will be a different measure between lenders. So it's really important to differentiate between a credit search and a credit score. The lender uses its credit score to actually assess that individual, which, from a lending point of view, is that person a good bet to lend to? Have they got the character to be able to service that debt? So based on all the factors that go into the score. So it's really important to make sure that as an individual, if you're taking that path to buy your home, then actually to put yourself in the best position, are your bank accounts up to date? You're not going overdrawn, and any finances that you have are all up to date. So actually you're seen as somebody good to lend to, because it's highly probable that you will repay that loan back over time.
And if someone's credit score isn't so great, what could they proactively do to manage that or get out of the red?
Yeah, so again, it's focusing on what could actually be triggering that decline in score, because there are a number of lenders out there that will support customers whose score is maybe a little bit lower. There may be influencing factors involved. So could there be something that has triggered that from a debt point of view? So again, it's just reflecting and perhaps utilising the information that's obtained through a credit search to say, actually, how healthy is my financial situation? Have I kept all of my records up to date? I'm on the voters roll, or my address is clear. That's really the due diligence that individual could carry out.
Okay. And I've got to ask this because I have no idea if this is a myth or not. But if a friend sends you a bank transfer and they perhaps put something quite questionable in the subjects, Can that
hope not.
impact your ability to get a mortgage?
Wouldn't necessarily impact. I think if an underwriter who is looking to assess the loan application is reviewing that, it may trigger additional questions, and because it might not be clear, what is that transfer for? Because the underwriter is typically going to be looking at the health of the bank statement, the transactions, and it's building up a picture of that individual to be able to lend to. So I think it's something that could pose a few questions.
I'm not asking from experience or anything like that.
I gather. Yeah.
Now, there are lots of types of mortgages to support buying a home. What types of mortgages do Barclays offer?
Yeah, we could talk to you about that. So like we were saying, it can be quite overwhelming. You've got lots to think about when you're actually buying a property. Who do I get advice from? Which lender do I go to? There's also lots of different mortgage options. And I think the first thing I'd probably say is the importance of getting advice. You can go direct to a lender. So you can go into a bank in a high street like Barclays, or you can speak to a broker who will give you advice on every different lender. So if you go in to speak to Barclays, we will speak to you about Barclays products and mortgages. If you speak to a broker, you'll get a varied range of mortgages from different lenders. So really important to do that. What they'll do is they'll do a fact find with you, and they'll find out lots of different information about yourself. So the deposit being one of them. How much deposit do you have? Where's that deposit coming from? Who are you buying that property with? Are you buying it on your own? There's lots of myths out there, and I think people are still sometimes in the mindset that you can only go and get a mortgage with yourself and your partner or your spouse or your husband or your wife, but that's not necessarily true. It could be a friend, a family member. They could be helping you with the deposit. So all of those things combined might have an effect on which product is recommended to you and which you can do. And then also your income. So depending, you could be employed by a bank like we are and have kind of a regular income coming in, or you could be self-employed. And there's probably another myth out there that if you're self-employed and haven't been self-employed that long, that you can't get a mortgage or a mortgage product, and that's just not true. That's not true at all. I think we saw some survey results recently. Over 65% of self-employed people don't believe that they can get a mortgage, so they don't go and look. And so that's why we'd always say to everyone to encourage you to have a conversation with someone, because they will find a lender out there that will be able to help you with that, and we can help with that as well. So yes, lots of different things.
That's really interesting.
We're probably generally talking to people today about someone who wants to take out a residential mortgage. So that's a mortgage for yourself on a property that you're going to live on. You could also look at a buy-to-let mortgage. So if you were looking at buying a property and you wanted to rent that out to someone else, that's something else that we offer. It could be a new build property. It could be a second-hand property, as we call it, which always sounds slightly strange, doesn't it? A second-hand property. But depending on that, there could be some schemes that your house builder, who Matt deals with a lot, that be able to help you with different products and different things to look after. And then obviously shared ownership, which is very, very close to your heart. Right to buy as well. So depending, you could be living somewhere at the moment that you have the right to buy that property that we can help you with as well. So there's a varied range, and just reiterate the importance of going and speaking to someone just to really understand what you're eligible for and what you need.
Absolutely. And if you're looking for a shared ownership mortgage, you need to be speaking to someone who really understands the product as well, which is key. Yeah. Now, there are some big costs associated with buying a home. You've got stamp duty, you've got legal costs. Can you add that to your mortgage? How does it work?
Well, that actually comes down to budget planning. So as part of the application process and assessing affordability to what you can actually borrow as a customer to buy that dream property, it's looking at all associated costs. So is there a fee for evaluation? What would stamp duty costs? When obviously the stamp duty holiday is coming to the end of this month, so what will that cost actually be to me for that property? Are there any other costs that are involved? So things such as, if I've got to move and if I've got to store furniture, are there other things that need to do? Because I may be renting currently. So all of that will be taken into account, and that will then dictate from a deposit point of view how much of a deposit, because obviously I've worked hard to build up savings to be able to buy that property. What deposit do I need for the mortgage? But also out of those savings, how much have I got to put towards those associated costs? So it's linking it all together from a lending point of view. How much do I need to borrow? Because I've got a level of savings towards my deposit that the lender wants, but also a level of savings that will go towards those associated costs as well.
Okay, got it. So you can't actually put stamp duty on a loan, but you look at your total deposit available, you think what costs you've got to take out of that to support your purchase, and then you add to the loan based on the borrowing that you need. Got it. Okay, thank you for that, Matt. Now, what about family members? You've got a very generous family member that wants to give you some money towards your home. How does that work? Can they finance it in some way?
Yeah, I mean, there's nothing better than a generous family member, is there? so we see family members supporting customers in a number of ways. Deposit is something that they typically help with, and deposit is one of the challenging factors with house prices in a customer being able to build that up, especially for first-time buyers. So they're working really hard to save that deposit. So family help is absolutely important and can be critical in achieving that purchase. From a mortgage point of view, at Barclays we offer what we call a mortgage boost. So it would be a joint application. So we do see this a lot with family members. So a family member could go on the mortgage with an individual, and they wouldn't actually be living in the property. But what we do is we assess the mortgage application, so how much we will lend, and our affordability calculations to make sure that it is an affordable mortgage to that customer on the joint incomes. But the individual, the family member, for example, who is helping, is the what we call the non-proprietor, isn't living in the property. So it actually accesses their income to help achieve the mortgage, and we find that that's a really popular product. Obviously, for those that have sought the advice, to know that it is absolutely appropriate for them to do that.
Yeah, and I think that's where shared ownership is great, because it's allowing people to save realistically for a deposit on a home. So it's made it far more accessible. But we still get shared owners that come to us and they've been gifted some money, which is great, which actually sometimes means that they can buy a bigger share. But we're going to talk about that a little bit later on. So obviously shared ownership mortgages, they're slightly different to a standard mortgage. But what's the difference?
Okay, so it very much in the name, shared ownership. So as a customer applying for shared ownership, I would be purchasing a share in that property, and I would be paying rent on the remaining share, typically to a housing association who is what we would call the provider of that particular scheme. So we know that shared ownership is extremely popular. It's been in the market and supporting customers and offering that path towards home ownership for over 40 years. So there's a number of properties that are available for that, and there's a number of mortgage providers that do support customers looking to purchase a share, and the share will depend on income and affordability. The starting point for that customer is they will go through quite a rigorous process with the provider of the shared ownership property to assess what share they could actually purchase based on their income and affordability.
And it doesn't mean you have to share with a stranger.
No, it doesn't. It doesn't.
Common misconception, isn't it?
It is.
Yeah, well, interestingly, one that we've all heard somewhere down the line through various customers. There's other mortgages that perhaps people might not have heard of. One I find really quite interesting is green mortgages. Saving energy, it's quite a relevant topic at the moment. But what is a green mortgage? What's it all about?
And relevant is absolutely the right phrase. It's something that's really important, and especially for customers, if there's the ability, if there's an energy efficient property that may cost less to run. That's ideal for somebody that's starting out in their first property. So at Barclays, we do offer green home. We call them green home mortgages. So if a customer is purchasing a new build property and it has an EPC rating of A or B, then we will offer them access to those products. The interest rate will be slightly lower. There are a number of green mortgage products that are available in the marketplace, and they offer different options. Some may offer cashbacks, but it's a feature for an energy efficient property, and there's certain rules across lenders as to what they would deem an energy efficient property. But if somebody's got the ability to get a better rate for the properties that they're buying, then absolutely that really helps them.
No, that is interesting, and I know that obviously if you're buying a property with a higher EPC rating, then your energy bills are going to be less as well. So, there's a cost saving there. Yes. I have heard of some green mortgages where you borrow more and you get your insulation done, you can get solar panels and all sorts of bells and whistles. But obviously there's a big cost associated with doing that. But no, it's interesting that Barclays offer a similar product as well. But let's talk about remortgaging. What is a remortgage firstly, and how does it work?
A remortgage. So you've already taken out your mortgage, so you purchased your property. You might have had a mortgage for 5 years, but your interest, when we talked about fixed rate mortgages or tracker mortgages, may be coming to an end. At that point, you'll want to take another fixed rate or another tracker product going forward, so you can remortgage at that time. There could be a different circumstance that you remortgage as well. So you could be moving house or doing something like that. So you'd want to remortgage at that time. You mentioned your early repayment charge earlier, so you had to make sure that those timings are completely right. But yes, so you remortgage at the end of your term of your fixed rate or your tracker.
Okay. Are there any benefits for remortgaging with Barclays?
Yeah, I guess when you start out your journey and you're looking at a lender for where you go to, it'd be a similar concept when you're remortgaging as well. So you're most likely going to go back to your broker or the point that you took the mortgage from as well to make sure you've got the right advice. But cost is probably going to come into it a lot. Barclays are a high street lender, so generally we have very good rates that are on the market. Speed of service, so we're a very large lender as well. So got lots of very tech people in the background who process our applications really fast. So that's something. A lot of people might like using an app and stuff like that. So we have an app that you can use. So lots of different benefits for remortgaging with Barclays, but you're probably going to look at the cost and then your scenario, all the scenarios that we talked about. So if you'd had a change in your income, or the way that you're paid, again, changing property, something like that, they're all things to consider as well.
I have actually remortgaged with Barclays before, so I know the app that you're talking about.
Good.
It was brilliant. It tells you exactly the steps and the things that you need to upload, and you can literally see your transaction go through. I barely had to phone anyone, so it was really quick. Yeah. So I can verify, and I think as a tested customer, it works.
And I think you've hit the nail on the head there. Everyone likes to deal with their mortgage and their mortgage lender in a different way. Someone might want to speak to someone on the phone, and we have hundreds of staff across the UK that you can pick up the phone to and speak to immediately, or you might not want to talk to anyone. You just want to get it done quick, do it on the app.
I didn't need to. It was all done on the app.
Perfect.
So,
Perfect.
But let's bring it back into shared ownership now. So shared owners at the point of remortgage, they might want to consider staircasing. I don't know if you could perhaps explain how that would work in terms of a remortgage. And when I say staircasing, I obviously mean buying more shares.
Yeah. So staircasing is obviously going up taking those steps towards potentially full ownership.
Yeah.
So at the time of remortgaging, I suppose if we take it back a step to the initial transaction, initial purchase, what's really important at that time for the customer is to understand not only the terms around that initial purchase and the share that they're buying and the rent they're going to pay, but what options are available for them in the future. Hopefully that customer will see an increase in income, circumstances may change, and they may be in a position to afford a higher share percentage of that property. So remortgaging is always perhaps an appropriate time to tie that in, because it's a time to reassess customer circumstances, change of product. If their income has increased and they've got the ability, to afford more, then that could be done at that time to look at, okay, could I buy a bigger share in that property, and assess that. So from a remortgage point of view, that application would then not only be the initial balance or the balance at that time is coming out of time. We've talked about being tied into a product, so product is probably coming to the end of its time period, would be actually to remortgage and raise those funds to actually buy that increased share. So it can be a good time to do that in that transaction. Again, with a mind towards any associated costs, what the transaction timescale would be, but that's something that lenders can absolutely support.
Yeah, and something that we absolutely support as well at Resi. So we help hundreds of customers staircase every year. And actually, at the point where you're looking at a remortgage, that you can either staircase to 100% if you're able to do so, or you might actually explore in that conversation that you've actually built up enough equity in your home to buy on the open market, which is another route to achieving full ownership. But having those discussions with a mortgage expert is probably key in establishing that. Yeah,
it's that point. It's really understanding what options are available to me. So, I've bought this shared ownership property. Do I want to increase the share that I've got? I've got the income to do so. What is available to me? So it's really understanding what that property and what that product can do for you.
Yeah. Okay, so let's talk about customers who are already well established in their mortgages. And, it happens, perhaps things aren't going so well, they've missed some payments. What support is there for customers who perhaps are struggling a bit financially?
So what's really important is when a customer takes out a mortgage, as a lender, we absolutely want to support that customer into shared ownership. And we'll do a number of different checks around their income and affordability and what we call stress testing. So we will test their income at a higher level to see, if interest rates did increase, would they be able to cope with an increase in payments should that happen? So we do as many checks as possible up front to not only help that customer into home ownership, but we want to help them maintain home ownership and keep them in the property. So if circumstances were to change, and the customer was to get into a position where they thought they might be coming into a financial difficulty, the first thing we would always say to them is absolutely reach out to us. We want to support that customer. There's a number of options that are available to that customer that we could help with. There's lots of information on our website, through our mortgage support hub. We as a lender, we're signed up to the mortgage charter. So it's absolutely, in the customer's interest to reach out to us because we've got their best interests at heart, for sure.
It's very easy, isn't it, when you're under financial pressure to sometimes bury your head in the sand. But I think you've just explained it so well. It's really important to talk because there are solutions and there is assistance out there. Yeah. We have a team at Resi, and most housing associations have exactly the same, where they do have some support, where they can offer some guidance. And there are instances where your provider, your housing association, is actually able to help you. So it's absolutely worth picking up the phone and having those conversations early.
Yeah, definitely.
Absolutely. But obviously, it's also really great to see Barclays supporting so many first-time buyers into the market. How is it looking at the moment for first-time buyers?
It's a tricky market for first-time buyers, right? If you're a first-time buyer in the UK at the moment, you're probably going to be around, the average age is 34. If you're in London or closer to London, it's 36. So that's really difficult. Having help from a family member as a deposit, or like Matt mentioned, our boost product, so having someone else that can come onto the mortgage with you is just absolutely imperative.
And how many first-time buyers are you supporting at the moment, if you have that number?
So we publish what we call our property insights from Barclays, which gives customers great detail in what's happening in the market. So our latest data shows us that since the autumn budget, we did see an increase in mortgage completions. So there was an increase, roughly about 26% that we saw at Barclays in completions. And that was actually driven by a 59% increase in first-time buyer completions. So we can see that actually, the numbers are telling us that, we are supporting first-time buyers. We absolutely want to support, the home buyers of the future. So because they are so important to a healthy market. But like I said, the data is telling us from what we can see, and it's out there in our property insights that we are supporting those and we're seeing good numbers come through.
Yeah, despite all those challenges, first-time buyers are still finding a way, and hopefully our products are one option to take.
Yeah.
Exactly.
Excellent. Well, Matt, Francis, you've been absolutely amazing. Thank you so much for joining us today. And thank you to our listeners. And don't forget, if you want to hear more shared ownership content, don't forget to like and subscribe. Please send us a message if there's any topics that you'd like covered. You can find us on all the main podcast platforms such as YouTube, Spotify and Apple Podcast. Until next time, this is So in the Know.